Hello, my name is En Yao, Managing Director and Head of Private Equity Funds in Azalea. Thank you for taking the time to join us to understand the Astrea VI transaction. Astrea VI is offering three classes of PE bonds, Class A1, A2, and B. This table here shows an overview of all three classes with their respective issuance sizes, the expected credit ratings from Fitch and S&P, the interest rates, the scheduled call dates, and the maturity date of the bonds. All the interest rates for the different classes of bonds have been set and priced by institutional and accredited investors through a competitive book building process. A portion of the Class A1 bonds are offered to retail investors in Singapore through the public offering. The remaining bonds were distributed to institutional and accredited investors through a placement offering. The bonds are backed by cash flows from a diversified portfolio of private equity funds, total of $1.5 billion. Class A1 bonds are expected to be rated A+ by both Fitch and S&P, which is an investment grade rating. The Class A1 bonds will be listed and traded on the SGX main board. A total of 250 million Sing dollars of Class A1 bonds will be offered to retail investors, and these bonds have a fixed interest rate of 3% per annum, payable semi-annually. There will be a bonus interest of 0.5% of the principal amount payable to Class A1 bondholders at redemption if performance conditions are met. We will elaborate more on this performance threshold later. The Class A1 bonds have a legal maturity of 10 years, but a mandatory call at the end of year 5 if conditions are met, such as there being sufficient reserves to redeem the bonds. The scheduled call date is in March 2026, the 5th anniversary of the bond's issuance. If the Class A1 bonds are not redeemed on the scheduled call date, there will be a one-time 1% step-up in the interest rate. Let me explain the transaction structure of Astrea VI. The transaction is managed by Azalea, and the cash flows are administered by Sun. Sun is an established fund administrator, and its parent is listed on the London Stock Exchange. On the right are the other counterparties involved in the transaction. Besides the bondholders, we have DBS Bank acting as credit facility provider. This credit facility can be drawn to pay capital calls issued by the underlying PE funds or to pay bondholders' interest in case of cash flow shortfalls. Other counterparties include the hedge providers as well as the bonds and security trustees. Here, allow me to explain in simple conceptual terms on how Astrea VI PE bonds are backed by cash flows from investments in 35 PE funds. An Astrea VI subsidiary owns interests in the 35 PE funds. Altogether, these funds have invested in a total of 802 investee companies at launch. When investments in these companies are sold by the PE fund managers, the cash is distributed to Astrea VI. The cash can be used to fund capital calls at any time, and at the end of every 6 months, any remaining cash must flow through a waterfall called priority of payments. How the cash can be used is strictly governed by this waterfall. I will now share a simple conceptual illustration of how the priority of payments work. Let me run through the various clauses. Clauses 1 to 4 represent key fees and expenses necessary to run the structure. In Clause 1, available cash flow is used to pay for any taxes and administrative expenses up to a cap of $0.9 million per distribution period. In Clause 2, payments under the hedging arrangements. In Clause 3, payments are made for the management fees. In Clause 4, payments are made to pay commitment fees for the credit facility, as well as any interest and principal if the facility is drawn. Clauses 5 and 6 represent interest payments to all bondholders, with Class A bondholders ranking ahead of Class B bondholders. Clauses 7 to 10 represent cash used for reserves and principal repayments. If the issuer sells any of the PE fund's investments, Clause 7 ensures that the net cash proceeds from any sale after fulfilling senior obligations can only be used to fund the reserves accounts or to repay any outstanding bonds. Clause 8 allows sufficient cash to be built up to redeem Class A bonds. Regular reserves, amounts equivalent to 1/10 of the principal amount of Class A bonds, are scheduled to be set aside every 6 months for the eventual repayment of the Class A bonds at the end of year 5. If at any period of the scheduled amounts are not fully reserved, the issuer has to make good on any outstanding amount in the subsequent period before continuing with the regular reserve schedule. When Class A bonds are fully redeemed, Clause 9 will kick in to start repaying the Class B bonds. Clause 10 is a structural safeguard. This is where the maximum LTV ratio is tested to ensure that there are sufficient assets remaining in the structure as buffer for bondholders. If the 50% loan-to-value ratio is exceeded, the sponsor cannot receive any cash unless more cash is set aside in the reserves accounts or bonds are repaid such that the loan-to-value ratio falls below 50%. Clause 11 and Clause 12 take care of any remaining expenses. And finally, we have Clause 13 as payment to the sponsor, the owner of the equity. I mentioned the performance threshold earlier. Performance threshold is met when the sponsor receives 50% of the issuer's equity by end of year 5. When the performance threshold is met, 2 things will happen. 1, Class A bondholders will be entitled to a bonus interest equivalent to 0.5% of their principal amount to be paid at redemption. 2, sponsor sharing will kick in. This means that sponsor will share half of the cash flow otherwise due to it into the reserve accounts until Class A is fully reserved. In other words, there is a possibility that the reserves account will be fully funded before the end of year 5. However, even in that case, the redemption will only take place on the 5th anniversary of the scheduled call date. Our bonds have 3 key credit strengths that I would like to highlight. 1. The bonds are backed by cash flow from a diversified quality portfolio of PE funds. 2. With an over-collateralized capital structure where the portfolio value is more than twice the amount of the bonds issued, the loan-to-value ratio is below 50%. 3. There are several structural safeguards to enable bond interest and principal repayment to be paid on time. Let's go through these in more details. The Astra VI portfolio is geographically diverse, with 61% in the US and the balance in Europe and Asia. US is the most developed PE market, while Europe and Asia are fast-growing and provide diversification. The Astrea VI portfolio is strategically focused, with over 80% of the portfolio comprising of buyout funds and the remainder in growth funds. There is no single name concentration in any funds or managers. The portfolio is diversified across vintages. The portfolio has a weighted average fund age of 5.8 years, which is a mature portfolio and is more cash generative. The portfolio comprises 802 investee companies across many different industry sectors. The largest investment is less than 3% of the portfolio NAV, showing how well diversified the portfolio is, with no single company concentration. The capital structure is over-collateralized, and the total amount of the bonds issued represents less than 50% of the portfolio value. This means the value of assets is more than twice the value of the bonds issued. Investors should also note that the Class A1 and Class A2 bonds are ranked equally as the most senior class of bonds. Another credit strength is the provision of structural safeguards. First, there are reserves accounts. Cash is reserved every 6 months over 5 years to build up sufficient cash to redeem Class A1 and Class A2 bonds. Second, there is a sponsor sharing mechanism. This enables a faster build-up of reserves for Class A bondholders after the performance threshold is met. Third, there is a maximum LTV ratio mechanism. If the LTV exceeds 50%, cash cannot flow to the sponsor and must be used to deliver the structure by either accelerating payments to the reserves accounts or by repaying the outstanding bonds. Fourth, there is a credit facility provided by DBS Bank. In the event of cash flow shortfalls, the credit facility can be drawn to fund certain expenses, including management fees, interest expenses, and capital costs. However, the credit facility cannot be used to repay the bond principal. This concludes the overview of Astrea VI. Thank you.